The world seems to have changed, but it's changed in a way that we think we recognize, which is the swings and roundabouts of economic nationalism, if you like, open trade, closed trade. So our value proposition as Singapore Exchange, founded and set up in Singapore, has always been about facilitating trade, and sometimes, more often than not, when barriers start coming down, there's more of a value proposition for offshore jurisdictions to demonstrate their worth to merchant values, meaning as a country, as a jurisdiction, you're not really very large as a net producer, as a net consumer. So people fundamentally trust you just as a place to do business, just as a place to find pricing, to share information, and that's what exchanges do. Still, by and large, the largest part of our franchise is equity derivatives, so investment access to the various jurisdictions in Asia which are capital controlled. And the amount of radical economic policy change that's happening in the big three, which is India, Japan and China, collectively accounting for something which is slightly larger than the US, 25% of GDP, world GDP, 40% of the world population. The amount of radical economic policy making in each one of these countries gives us belief that when you look at Asia as a whole, as an investment or risk management destination, it's going to be very idiosyncratic in risk, meaning all the elements of risk in there aren't going to be proxies for each other. Each will behave in a very distinct way, and in these environments is when people need to understand their correlation risk, their dispersion risk, how much beta they have, how much alpha they have. We are firstly an offshore exchange, but an offshore Asian exchange. There really isn't any other. So our overall liquidity pool isn't considered that large by global standards, although it's considered very meaningful for the markets we serve. So we are 40% of the Indian equity market. We are 20% of the Japanese equity market. We're 30% of the Chinese equity market. We can only serve to the extent that the underlying market is mature enough or liquid enough. The real challenges will occur in the sort of unbounded markets. So bounded markets might be markets like equities, where there's a natural limit to how much you can turn over in a single stock. The sort of unbounded markets would be things like currencies or commodities. So if you look at the most liquid examples, dollar yen or euro dollar, the amount of activity that happens in those currencies relative to the economic size of Japan or Europe is not even being approached for China or India or Indonesia or Malaysia or Thailand. Something like gold might turn over 100 times what physical turnover is. You look at crude oil, it might turn over 20, 30, 50 times what the underlying physical market is. While I don't truly mean unbounded, it is as good as unbounded for the next decade or so if the growth trajectory of these marketplaces continues the way we've seen it elsewhere. Because of the business model that we represent, which is an offshore market jurisdiction for international investors to get access to onshore jurisdictions, when there are capital controls or when there's a tightening of credit intermediation between clients or between market infrastructures, that typically is a challenge for us because it's a throttling of some of the things which naturally bring liquidity. So it's a supply challenge. But simultaneously, we have much more demand coming to us in those circumstances. So the number one challenge I see going forward is when you have very sudden changes in capital access or capital market infrastructure. You deal simultaneously with a constricting supply of liquidity and a much greater demand for liquidity, and you have to handle both those things at once while making sure your marketplace is still fair, orderly, transparent, safe, efficient.